Imagine investing just £100 a month from your 20s. Over several decades, that simple habit could potentially grow into hundreds of thousands of pounds. But most people never start because the stock market feels confusing, risky, or like something only wealthy people understand. In this video, I'm going to break down exactly how beginners in the UK can start investing, what platforms they can use, what types of investments exist, and the mistakes you need to avoid. The stock market is simply a marketplace where people buy and sell ownership in companies. When you buy a share, you become a small owner of that company. For example, if you buy one share of Apple, you own a tiny piece of Apple. If Apple grows, increases profits, and becomes more valuable, your investment may increase in value too. Some of the world's biggest companies include Apple, Microsoft, Amazon, Alphabet, which owns Google, Nvidia, Tesla. In the UK, some of the biggest companies listed on the London Stock Exchange include Shell plc, AstraZeneca, HSBC Holdings, Unilever. These companies are part of the FTSE 100, which tracks 100 of the largest companies listed in the UK. Saving money in a bank account is important for emergencies, but over long periods inflation can reduce your purchasing power. For example, if inflation averages 3% per year, something costing £100 today could cost around £134 in 10 years. Investing gives your money the opportunity to grow faster than inflation over the long term. However, investing comes with risk. Your investments can go down as well as up, especially in the short term. The goal is not to avoid every market drop. The goal is to build a portfolio designed for long-term growth. Now you understand why investing matters. But before you buy your first share, you need somewhere to actually invest. The first thing you need is a brokerage account. A broker is the company that allows you to buy and sell investments. Popular UK investment platforms include Vanguard is one of the world's largest investment companies. It is popular among beginners because of its simple approach and low-cost index funds. Many long-term investors use Vanguard funds because they provide broad diversification. Examples include Vanguard FTSE Global All Cap Index Fund, Vanguard S&P 500 UCITS ETF. Trading 212 is popular with beginner investors because it offers a simple mobile app, fractional shares, commission-free trading on many investments. This means someone could potentially buy a small piece of expensive shares rather than needing hundreds of pounds up front. For example, a single share of some companies may cost hundreds of pounds. Fractional investing allows beginners to start with smaller amounts. AJ Bell is a well-established UK investment platform. It offers stocks and shares ISAs, pension accounts, investment funds, individual shares. It is often used by investors building larger portfolios. Hargreaves Lansdown is one of the UK's largest investment platforms. It offers ISAs, pensions, funds, shares, financial research tools. Many UK investors start with a stocks and shares ISA. An ISA allows you to invest while sheltering your investments from UK tax on gains and income within the annual ISA allowance. For many beginners, this is one of the first accounts they research. Now you have a platform. The next question is the most important one. What should you actually invest in? This means buying shares in individual companies. Examples: Apple, Microsoft, Amazon, Nvidia, Tesla, or UK companies like Shell, HSBC, AstraZeneca. The advantage? If you choose a successful company, your returns could be significant. The disadvantage? You are relying on one company performing well. For example, if a company faces poor management, competition, falling profits, regulatory problems, the share price could fall significantly. Many beginner investors choose funds instead. An ETF or index fund allows you to own hundreds or thousands of companies in one investment. Examples: the S&P 500 tracks 500 of America's largest companies. It includes companies like Apple, Microsoft, Amazon, Google, NVIDIA. Popular examples include Vanguard S&P 500 UCITS ETF, iShares Core S&P 500 UCITS ETF. A global fund gives exposure to companies around the world. Examples include Vanguard FTSE Global All Cap Index Fund, Vanguard FTSE All World ETF. This means instead of betting on one country or company, you own thousands of businesses worldwide. Imagine investing £10,000 into one company. If that company falls 50%, your investment falls 50%. But if you spread your money across thousands of companies, one company performing badly has much less impact. This is why many long-term investors prefer diversified funds. So now you know what you can invest in. But the biggest factor in investing success is not picking the perfect stock. It's your behavior. A common mistake beginners make is waiting for the perfect time. The truth? Nobody knows exactly when the market will go up or down. Instead, many investors use. This means investing the same amount regularly. Example, you invest £200 every month. Month 1, the market is high. Month 2, the market drops. Month 3, the market recovers. You continue investing regardless. Over time, you buy at different prices. You don't need thousands of pounds. Examples, £50 per month, £100 per month, £250 per month. The important factor is consistency. Compound growth means your returns can generate their own returns. For example, you invest money. Your investment grows. The growth itself then starts generating more growth. This is why time is one of the biggest advantages investors have. Someone might decide to build an emergency fund, open a stocks and shares ISA, invest £100 monthly into a diversified index fund, continue for decades. This is not exciting, but investing success is often built through boring consistency. Before you start investing, let's talk about the mistakes that destroy many beginners' portfolios. The internet is full of people promising, turn £100 into £10,000. Most of these strategies involve huge risks. Successful investing usually takes years. A stock trending on TikTok or Reddit does not automatically mean it's a good investment. Before investing, understand the company, its profits, its risks, your reason for buying. Markets crash. It happened during the 2008 financial crisis, the COVID market crash, various economic downturns. Many investors lose money because they sell when prices fall. Long-term investors understand that volatility is part of investing. Before investing, ask, why am I investing? Is it for retirement, buying a house, financial independence, long-term wealth? Your goal affects your strategy. Small fees can have a huge impact over decades. Always understand platform fees, fund fees, trading costs. Investing in the stock market doesn't require you to be a financial expert. You don't need thousands of pounds. You don't need to predict the next big company. You need a plan, patience, and consistency. Start small. Keep learning. Invest for the long term. Because the biggest advantage you have isn't timing the market. It's time in the market. Thanks for watching. Subscribe for more beginner-friendly UK investing guides.
Disclaimer: this video is for educational purposes only and is not financial advice. Investments can fall as well as rise, and you may get back less than you invest.